negative rates are carrying a lot of downside risk. I think they can have effects on monetary policy, but those effects are more pronounced in small open economies where the interest rate differential matters a lot for the pricing of the currency. And so we've seen some of the smaller economies, Denmark, Sweden, with their own currencies, or Switzerland, use these negative rates early on to basically establish a less firm currency. But for large economies like the Eurozone or Japan, the effects of negative rates could easily go the other way. And that's largely related to the fact that what you usually want to do is lowering rates or going into negative territory. You want to boost consumption and reduce savings. But it could well be that if people look at their pension entitlements and if they look at the ability of their pension funds and life insurance companies to earn them a decent pension, that ability goes down dramatically in a negative interest rate environment. So they might just overall be concerned about their level of pension and start saving more rather than saving less, and consuming less rather than consuming more.
So sort of a deflationary mindset, and you're literally killing whatever animal spirits are out there. Let me ask you, though, this new twist that we're seeing the ECB starting to follow now, not so much worried about the currency, the euro, but more about getting credit out there into the real economy. Is that the right thing to do?
Well, I think in general, in a bank-based system like Europe, reinvigorating credit is the first step to reinvigorating investment and therefore reinvigorating growth. So it's absolutely the right thing to do. But you got to see at the moment, banks' ability to provide credit to the economy is impacted by two things. First is, as negative rates hold, we're repricing some of our products, and actually, as a matter of fact, credit is getting more expensive in those areas where you can actually increase prices for those products. So it goes the other way again. And the second thing that is happening is there's a lot of regulatory requirements. We talked in the past 2 weeks a lot about European banks that need to fortify their balance sheet and, basically raise their capital ratios. And that happens at the moment. And as that happens, banks are more concerned about the solidity of their balance sheet rather than giving out new credit. So there is a regulatory headwind in addition to the monetary policy that might make the net effect less pronounced than in a normal environment.
Gotcha.